We're going to talk to Kirtan Shah, who is the co-founder and chief executive officer of SRE Wealth. Thank you so much, Kirtan, for taking the time. We're speaking about hybrid funds today. Let's first answer the most basic question. What are they and what purpose do they serve?
Alex, thank you so much for having me on the show. So, Alex, if you look at the broader framework of how mutual funds are formed, while as per SEBI, there are 5 different categories or types of funds that you can see in a mutual fund, primarily we should look at the 3 major ones. So, there is something called as an equity scheme, which majorly invests in equity. Then there is a debt scheme, which is majorly investing in debt. And then you have this third category, which is called the hybrid, which is investing in multiple assets. So typically a hybrid scheme is a combination, whereas a single fund can invest in equity, can invest in debt, can invest in preference shares, REITs and InvITs, right? Or gold, right? So it's a scheme where 4, 5, 3, 4 of these assets come together and they're put together in multiple combinations, whereby the fund is trying to reduce the volatility of the scheme versus a pure equity scheme, and is trying to generate decent risk-adjusted returns. So that is broadly what a hybrid scheme is, in my opinion. And if you really ask me, what purpose does this really solve? Look, ideally there are 6, 7 different types of hybrid schemes, and each of these schemes are meant to be for a specific set of purpose. Like say, for example, somebody wants to park liquid money, right? So you have something called as a liquid fund, but if at all you have, let's say, a 5-6 months of investment horizon, instead of doing a liquid scheme, you can do something called as an arbitrage fund, which is also a type of hybrid, right? Now the advantage of doing an arbitrage is typically you end up paying less tax versus your liquid fund, and it almost ends up solving the same problem for which the liquid fund is meant. So depending on what category out of the 6, 7 we are really investing in, I think the use case is more specific, Alex.
Let's talk about some of these types, at least the primary ones. You mentioned that there are several, but assuming that we're talking primarily about the requirement with the equity markets at all-time highs, if somebody is thinking that they want to be a little bit cautious in their allocation of incremental allocations to both the classes, equity and fixed income, where do we talk about hybrid funds?
So, Alex, in that case, in my opinion, there are probably 4 funds that we should be talking about, because we are majorly talking about, let's say, equity and fixed income. So there is something called as conservative hybrid fund. There is something called as balanced hybrid. There is something called as dynamic asset allocation or balance advantage fund. And then there is something called as equity savings fund. Of course, I'm not talking about the multi-asset and the arbitrage fund, because may not fit in the context of our discussion. But look, primarily, all of these funds are different from each other in terms of the exposure that each of these funds take to equity and debt separately. So to give you an example, a conservative hybrid fund is a fund in which the equity allocation can be anywhere in the range of 10 to 25%, and the remaining is majorly debt. Whereas a balanced hybrid fund is typically a one which has 40 to 60% in equity and 40 to 60% in debt. But while I talk about aggressive hybrid, we are talking about a fund which has 65 to 80% in equity and the remaining in debt. And then there is one more category that we spoke of, which is dynamic, in which there is actually no specification of how much money should you minimum or maximum have in equity, but it keeps moving around depending on where the equity markets are and how a fund is really positioned in terms of objective to take equity and debt exposure. So these are broadly the funds, along with something called as equity savings fund. These are broadly 4 or 5 funds in which probably people can look at investing right now. Equity saving is a fund in which unhedged equity will be anywhere in the range of 15% to 40 to 50%. So these are the 4 or 5 categories in which people can look at investing in the current time frame, in my opinion, Alex.
So I'm going to just repeat what you said. You've essentially talked about conservative hybrid funds, balanced hybrid, dynamic asset allocation, as well as equity savings. So my next question to you is, do these funds or do these schemes replace the need for asset allocation? Because you're talking about, in essence, schemes that have the freedom, or the fund manager has the freedom to change the asset allocation between equity and debt based on where he sees the nearing or the near-term triggers for the equity markets or the debt markets. Should this replace your asset allocation strategy though?
In my opinion, no, Alex. So I'll tell you broadly, you can bifurcate these funds that we are talking in by SEBI of how much should be the range within which you should play in equity and debt. And then there is a scheme where there is no specification. You are free to move your equity and debt allocation as much as you want. Now, in both of these cases put together, in my opinion, it does not change or it does not play a role where it can replace your asset allocation. A simple example or a reason why I would believe so, Alex, is because let's say in a balance advantage fund, right, where the fund allows you to move between, let's say, 10% to 90% in equity. So when markets are expensive, you typically go down on your equity exposure. And when markets are not expensive, you go high on your equity exposure. Now, in my opinion, imagine this fund which is managing tens of thousands of investors. Now, each of these investors may have either a conservative risk profile or a moderate or an aggressive risk profile. Imagine a situation if I'm an aggressive risk profile, but the fund, because of its understanding that the markets is expensive, brings down the equity exposure to as low as 20%. Or probably if I am conservative, but the fund thinks that the market is very fairly placed and increases the equity exposure to 80-90% in the scheme, that may not fit the kind of risk profile that I personally belong to. So I believe that a larger fund which is managing monies for tens and thousands of investors cannot be an asset allocation solution to each of these investors within the scheme, Alex.
Okay, let's delve a little deeper. What returns can one normally anticipate, and what is the risk profile that is associated with these? So there is obviously a very clear categorization and there is a wide gamut, but let's restrict to the ones that we were talking about, the four that we were primarily talking about. How does one understand the risk associated?
So, Alex, like I said, and while it is extremely clear, like the name suggests, if it's a conservative hybrid scheme, you're only taking 10 to 25% exposure to equity. But while it's an aggressive, you're taking 65 to 80% exposure to equity, right? So point number one, while you look at the name of the fund, broadly, you will be in a position to understand whether or not this is going to take high exposure to equity or low exposure to equity. So that's the first thing, in my opinion, anybody should keep in mind. Second, very importantly, of what kind of expectation should you have? Alex, I believe that hybrid funds are solving a problem where they reduce volatility than a pure equity fund. So definitely, in my opinion, it's going to be a big challenge for hybrid schemes to be able to deliver returns better than a pure equity fund in a very broader prospect, right? So while you invest in all of these funds, except the aggressive hybrid fund, all of these other funds that we spoke of, in my opinion, your expectations should be returns slightly higher than debt and returns slightly lower than equity. But if you look at the aggressive hybrid category in very specific, if you look at the last few years of data, this is one category with lower risk because it has roughly 20% of debt versus a 100% equity fund. Even by taking that lower risk, in many occasions or in most occasions, the aggressive hybrid category has been able to beat Nifty. So I think that's a very interesting proposition where you can look at aggressive hybrid as a replacement to your full equity fund, but look at all of these other funds that we spoke of in terms of risk return as expectation of return slightly higher than debt, but lower than pure equity funds, Alex.
Couple of very quick last questions, Kirtan. One, what is the tax aspect of these funds? Because they're not either pure equity or pure debt, how do they work? And the last question would be, among the ones that you've primarily mentioned and the big categories within hybrid, would you like to suggest a few names that our viewers can consider?
So, Alex, first, I think what we have to broadly understand is that any fund which has 65% exposure to equity in an average in the entire year, you will have that fund getting the equity taxation. So for less than 1 year, you pay 10% of capital gains. More than 1 year, you less than 1 year, you pay 15% of capital gains, and more than 1 year, you pay 10% of capital gains. Everything else where there is not 65% of average equity exposure for the year, you will end up paying debt taxation, which will get added to your income if your investment horizon is less than 3 years, and it will give you an indexation and 20% tax if you're more than 3 years. Now, broadly, if I have to tell you, while you look at conservative hybrid, while you look at balanced funds, right, both of these categories, out of the categories that we spoke, they follow the debt taxation. But if you look at aggressive, you look at dynamic, and you look at equity savings, they follow equity taxation. Now, very quickly, dynamic and equity savings theoretically may not have 65% exposure to equity, but both of these funds are allowed to take exposure in arbitrage. And because they take exposure in arbitrage, which is considered as equity, even when they bring down their equity exposure to the fund to 20%, 30%, the remaining is bridged by arbitrage opportunities, whereby they maintain that equity taxation. So that's one. Second, if I have to recommend specifically funds in the balance advantage category, I think I'll recommend two at the opposite spectrums, Alex. First is DSP Balance Advantage Fund, which in my opinion is extremely true to label. And second is Edelweiss, where they follow a completely different strategy, which is pro-cyclical. I think both of these funds are interesting and should definitely be looked at by investors.
Absolutely. It's an absolute pleasure, Kirtan, speaking with you, and I look forward to doing so in the near term. Thank you so much for joining in.
Thank you so much.
All right. On that